Join us now to talk about some of the big movers. Stephanie Link, Chief Investment Strategist, Portfolio Manager at Hightower Advisors. She's also a CNBC contributor. Stephanie, it's good to see you. For years, I just can't believe how much Windows still goes out the door. How many copies of that goes out the door at Microsoft? These are huge numbers that we're seeing. And you know, we hear that Google says, well, you know, our revenue actually declined, and it's happened a couple of times now. A decrease of less than 1%, that's just a quarter, $54.5 billion in revenue. And then, you know, Microsoft sees a 7% gain in revenue, which isn't double digit. But so I want to know about the individual companies and what it says about the operating environment, in this economy.
Well, I think both of these companies executed really well. And I mean, Microsoft clearly was the better of the two reports, but both really good underneath the surface. I mean, Microsoft, the whisper number for Azure was something like 26, 27%. I even saw a number yesterday at 20%, and it grew 31% constant currency. So I think that's the sigh of relief. But commercial bookings rose 12% year over year. Gross margins, operating margins expanded. So better than feared for sure, but also clean beats across the board. And that's why you're seeing the reaction. By the way, the stock is down 6% in the last 2 weeks, so it is just kind of reversing that. But really a nice number. And the stock trading at 29 times, Joe, I know it's expensive, but relative to its historical average of 36 times, it's actually cheaper on a relative basis. And of course, Google, Alphabet, really good too. I mean, they beat not as much, but also their cloud business of 28%, much better than kind of feared again. And the profitability in cloud really good. And I expected YouTube to be strong, but search was actually better than expected as well. So really good numbers from both of them. It's nice to see.
And we know it's about beating lowered expectations, but
yes.
And we're supposed to look at it and say, well, you know, versus last year or the year before, it's not as good. But was the pandemic environment normal, or is this normal? I mean, is it really slowing down, or was that not sustainable for tech? What we saw it's like saying, you know, gee, Zoom is down, but I mean, of course it's down. The results.
Well, I mean, look, if you look at cloud, 90% of companies are still on-prem, right, on premises. So there's still such a nice tailwind in terms of cloud. Did they all benefit from pandemic? Of course they did. And maybe last couple of quarters, they kind of had to normalize. But it does look like the steady state right now and going forward is still very, very strong and very positive. And we talk about total addressable markets. It's really big, right? I mean, across the board in cloud and AI and data center. So, there's a little uneasiness in terms of higher interest rates and what does that do for long duration assets and technology and growth stocks. But at the end of the day, it's hard to fight these really amazing trends. By the way, I actually thought Texas Instruments was also interesting, because the reason that's interesting is because they have 100,000 customers, right? And international, 90% of their business is outside of the U.S. And they actually were okay, right? In industrial and in auto, not so good in PCs, but we know that PCs is bad and it's starting to trough a bit. So I thought across the board, very encouraging data overnight.
Okay, when I read the intro, I was confused because it's not clear. The company did earn money in its cloud business. It generated $7.5 billion in revenue. Last year, it lost $5.8 billion. It lost $5.8 billion. That $7.5 billion in revenue generated a profit of $191 million. So I don't know, this is gobbledygook, the way we phrased it, but they were able, right? I mean, no, it sounded we were conflating revenue with that $5.8 billion loss in the year ago period, but they did make money. It was not a lot, but on $7.5 billion in revenue, they turned profitable. So there's so many things in these numbers that it doesn't look like the end of the world. I don't know whether that's good because the Fed means it's got to do more. We were just talking about that. I think it's good because it's slower than it had been, but could be a soft landing. It could indicate we could get a soft landing. It's not as good as it used to be.
Well,
go ahead.
Yeah. But you know what, Joe? I mean, there's so many people that are saying we're in an earnings recession. And by the way, there's so many people that are saying that we're already in a recession for the economy. Well, guess what? I mean, we've gotten about 15, 17% of the companies in the S&P 500 that have reported, and 75% of them are beating. I know it's against lowered expectations, but these companies are still being able to deliver results no matter what, right? And so that's very encouraging, and especially on the margin side, because so many people are talking about margins are going to get crushed. Margins across the board, at least so far, they've actually been quite good, and demand has held up. Demand might fall down a bit because we slow down. That's expected. But I don't know. I mean, I think these companies are really, they're delivering really good results, and I think that's something to be encouraged by.